Hello and welcome back to Stock Market Weekly. I'm your host, Evan Medeiros, and we've got an action-packed episode for you. We've got a ton to talk about. There were so many things happening this week, probably one of the busiest weeks in a while. Lots of different cross currents, lots of different risks, catalysts opening up. We're going to get into all of it. Stick around. It'll be a good episode. Let's jump right in. Our sponsor of this show is Investors Business Daily, and they have an offer for you, our listeners, in the description of this show to their Market Surge charting platform and their IBD digital subscription. Claim those offers in the description of the show once you're done watching the video. Thanks, IBD, for sponsoring today's episode. Let's get into our first story here. This is regional banks. So we have everyone kind of looking for the fire here. There's some smoke, and the market sold aggressively Thursday on these credit worry concerns and some fraud disclosures. So this is the KRE Regional Bank. Let me see if I can get my pen up here or to get some annotations. Thursday. And so Thursday's action here, this sell-off, this pickup in volume was sparked out of, I believe, Zions Bank and Western Alliance on some disclosed fraudulent loans. Maybe there's more details out there. I didn't get maybe the full insight story, but I know it was of the tune of $50 million, I believe, was disclosed. I think lots of these banks right now are keeping this close to the chest and kind of figuring out what's going on. The market right now is trying to figure out if this is an isolated event or not. In credit events like this, markets kind of shoot first, ask questions later. Things happen fast. Contagion risk can spread. It's something we want to be aware of. It might be isolated in kind of a couple of just single occurrences, but it's something, again, that is adding to some of these risk factors. And that's the theme that we're going to talk about today. There are numerous, this is kind of a multi-pronged kind of pockets of risk that the market is now grappling with. And it doesn't mean we're selling everything and just running for the hills, but it does mean we need to be aware acutely over the next couple of weeks. So this was kind of the first story that I think was notable on Friday's action. We did get a little bit of a rebound here. Seems like the coast is clear going into the weekend. That's good. It wasn't a follow-through selling event on Friday going into a weekend. That's when you start to get a lot more spooked and scared. And I should know, I did generate a lot of these slides probably about 30 minutes before the market closed. So if you're looking at some of the specific numbers and data and returns, we could be off a little bit by the actual weekly close by the time the market closes. Feel like it got kind of flown under the radar here, but again, potentially very important if this continues to spiral. This is US banks tapping the repo facility. And this is really around the SOFR kind of overnight lending rates where banks will deposit treasuries to get cash back. SOFR is climbing and Fed funds is not. SOFR relative to any of the short-term interest rates that you want to look at is starting to spike higher, which is signaling that there's some stress here in the market, that there's some illiquidity or some tightening of conditions. And there were some threads out there. I was reading on X by people that are more kind of plugged in on the real plumbing of the system more than I am. This could be related to potential the Treasury General account and government shutdown related activities where money is not able to kind of come out and disperse out into contracts and normal operations. There could be some other things going on. Regardless, this is another kind of important little seemingly innocent point right now, but if this continues, if stress and there's some ripple effects on carry trades and the way big institutions are kind of hedging out interest rate risk, there could be some interesting dislocations happening at exactly kind of the wrong time. So very important story. Let's pay attention to it, do some homework on it this weekend, see what else you can find. But this is something between both of these kind of credit events, I'll call them, and lumped together, we should be very acutely aware right now. I posted this chart earlier in the week. kind of unrelated, but this is high yield relative to IEF. So basically looking at, kind of junk spreads versus corporate credit. And the notable kind of takeaway here is that the red dashed line on this chart is the 50-day moving average, and it's starting to decline down, and we're trading below the 50-day moving average. So again, this kind of shows that there's a little bit of kind of some stress in the system here, that spreads are kind of widening out a little bit. We want to be on alert. It's not the ideal situation for, financial stability underneath the hood that you want to see. Okay, so there's some cracks here, right? And that's going to be a little bit of the themes that we're talking about today. And despite all of this, it looks like a glorious week on Wall Street, right? So equity markets are bouncing back sharply. Now, don't forget, last week was a good shot across the bow for risk and equities. They were down in the biggest week of, well, not the year, but since April, right? So this was mostly a recovery week and kind of staying in the range, but needless to say, no big follow through to last week's selling. If we take a look at the SPY this week, it was really the big gap up on Monday that did lots of kind of the uplift here. And then we kind of chopped around for the rest of the week and closed marginally higher. Again, these charts were taken about 30 minutes before the close, so I don't have the specific close. But this is, really what things look like here. This is a very kind of ominous looking chart now, and it's something where we have the ingredients for a directional move. We are building fuel in the fire here for this market to really run in a specific direction. And there are the two kind of catalysts or news flows that I just talked about. There's also obviously the government shutdown, which is now lingering into, I forget what week we're at now, but it seems like betting markets are saying we're going well into November. So we've got a government that's shut down. We've got some liquidity issues, overnight repo markets. We've got some potential regional bank stress. We have now kind of a feud with China and the trade negotiations that are kind of going south or just undetermined on where they are. And we have earnings season, which is right in front of us. So you have all of the excuses. There's so much bare food on the table to take this market down if one or more of these things start to go south. That's not to say that any of them will. If we can get through all those catalysts, or we get through the bulk of them without any really bad kind of, hits to us, this market's going higher, right? Like, this market will continue to climb this wall of worry, but there are plenty of little pockets here that we're going to want to observe. And the market, by this action here, a couple of things to note is just look at the range of these candles. We're expanding here. So realized volatility is rising, implied volatility is rising. And I saw some reports basically saying that top of bid, kind of top of book liquidity is starting to drift to lows. In other words, it's, market makers are taking a little bit of a step back here, and there's a lot of kind of event risk or news risk or Trump tweeting risk. Let's call it, I guess, what it is. And so it's tough to make a market when you can have a single headline that starts to cascade. So this is a point in time where if you're a very short-term trader, yes, sure, there is plenty of opportunity, but there is double the amount of risk right now, and you do want to just be aware of that. And for all the folks that maybe look at this market and kind of laugh and they say, well, look at the VIX. It was briefly at 25 and we're 2% away from all-time highs. This is insane. People are, so fearful. On one hand, I can empathize with that, but we just outlined a lot of potential series of risks in this market that if one or more can materialize, we could see a very swift sort of cascade down. And so to me, a 25, 20-ish fix kind of makes sense here. It doesn't actually sound that unreasonable given the potential for issues on the other side. Again, we're not making a claim that these issues will happen, but we are aware that there are risks out there kind of in the shadows. Now, here's the cues, right? The stage is set on all of these markets. We had this massive down day, biggest, down day in many months. And we spent the entire week just trading inside of last week's range. So that's why I say we're building some fuel here. We've got more earnings coming out next week. We have China, we've got the government shutdown. There's a lot for the market to digest right here. And which way we end up breaking is going to be, I would say, just of consequence of this range. So I posted a chart, I think on X earlier this week, basically saying it's all fun and games. As long as we're above 590 in the Qs, then life is good, right? Life can continue on and we can grind higher. But if we start to really lose, essentially this, Friday's lows here from last week, then you do need to be cautious that we could start to, really speed up the decline on the downside. And in last week's video, we sort of outlined where the market could go to. In fact, we basically said coming into this week, bulls need to hold the line fast, quickly, right? Like you got to hold the spot kind of where you are to keep this momentum intact. We basically said it could fall another 1%, but that's about it before we start to, really look at some bigger levels. And here we are. The market held exactly where it needed to. It held, in fact, we popped up on Monday. We gave no further selling from last Friday, and the bulls stepped in right where they needed to. So that's good, right? Check mark to the bulls, but we're not through the finish line yet. Let's pay close attention. Technicals are your friend here. There's lots of stories, but I would just keep it simple. 590 on the downside. I mean, if you want to really cheat, you could start to look at like this 593, 594 area, but that's your good line in the sand here to just manage risk is kind of the way I'm looking at it. Dollar index was basically down all week. And if we look at 10-year Treasury yield, pop the champagne, we got below 4%. That's, great to see. We did pop back up a little bit on Friday, but rates are coming down and the bond market, like we talked about last week, is actually acting as a little bit of a safety haven. So there you have it. 10-year Treasury yield below 4%. Let's see if it sticks there. And let's look at some sector performance this week. Again, lots of risks we're talking about, but pretty much everything is green. Real estate, discretionary, technology at the top of the list. Here's our 4 favorite sectors right now based on our smart trend filter indicator. We've got a handful, another 4, I guess, neutral, and then we've got 3 bearish right here: financials, discretionary, and energy. If we take a look at 52-week highs and lows under the hood, again, this is looking only at Thursday's data. We don't really have too much change here. We're just not seeing a big push one way or the other. We did get that flare up in the number of 52-week lows last Friday. So we got to about 120. That's still not quite an alarming amount. Something we'll pay attention to. We looked last week at sort of 1-month lows and some of those near-term levels that can signal, short-term exhaustion. But in terms of the bigger stuff, we're really not seeing too much change out of the ordinary there. I would say percentage of stocks above a 20 SMA, again, you're starting to get down to kind of this lower 2 standard deviation band. So you tend to find a market that wants to kind of buoy itself a little bit as you start to get to these more extreme oversold readings. Again, it could still get more oversold than it has, but the market has done a good job resetting at this point. And it's remarkable to say because we're only, a 1% or 2 from highs. Markets were up this week. Meanwhile, we're down here saying that stocks are oversold. It's quite a bizarre market, but a lot of that speaks to just the big heavyweights. Gold continues to be a story as well. I mean, last week we talked about the fact that as stretched as it is, it's just not a great idea to be wanting to short a market that looks like this, right? If you don't want to be long it at this point, I get it. Maybe some of the reward to risk ratios are a little skewed, but to short it sounds even worse to me. I still have that opinion, even after today. Yes, this was absolutely epic volume. I think this will be the heaviest volume ever for GLD. It looks to be, a down 1 or 2% session here. We'll see when we get the final numbers, but still short term, yes, that this may be your excuse to get a multi-day, even a multi-week correction. It still just seems like a market that I just would not feel too comfortable shorting at this point. There's lots of interesting dynamics that are just pointing to a parabolic gold at this point, and it's tough to call the very tops in these parabolic runs. Now, going the exact opposite way, you have oil. Oil now cratering to multi-month lows, starting to lose some levels, getting back down to bigger range lows. So maybe there's some value here. I know trade dynamics and a host of other things around drilling is affecting some of this here. I don't have a position, not really playing this, but certainly notable though, as we got gold parabolic, maybe at a short-term turning point, oil on the opposite side. And then of course, Bitcoin, holy moly, this has got volatility all over it. Just about 12 days ago, Bitcoin was making all-time highs, and now we're at about a 16% correction. So Bitcoin is kind of living in its old sort of memory now, right? This is how it used to trade before it was very institutionalized, where there's tons of volatility with aggressive highs and aggressive lows. And we're certainly seeing it this week. A couple weeks ago, I outlined a thesis that my bull trade to break out of this range to clear new highs and start to run. Last week, when we updated our video, I told you how the follow-up week, this is last week now, was not what I wanted to see. It was the exact opposite action I wanted to see, and my exuberance on that trade was downgraded. Monday is when I took that trade back off. I basically started the trade right in here on this kind of follow-through day, and I don't know how I ended up on the trade, but call it a small win. Nothing too exciting. I would have much preferred just the move to take place, obviously, but here we are. So with Bitcoin getting all the way back down on Friday's lows to sub 105, you have this potential double bottom. Maybe you just oversold and wiped out every aggressive long trader, myself included, that was trying to play a good, fast, swift breakout, and have washed them out. And maybe this can steady climb and start to move. For now, just the short-term signals, I don't have them yet. There's some washout levels for sure if you're tactical. But for me, I'm going to just say the same things I've been saying all year. I think 110 is an important level for Bitcoin. I'd want to see it over that, and then I'd want to see it over 115. That's the broken record. I've been saying that in this range and for all of this chop, and I still believe those are key unlocks that I want to see the market get back above. Getting back above 110 here and getting into that 115 when it looked like it was about to go is essentially what got me in the trade on this short-term pop, and now we'll see if we can just repeat it again going into the following weeks. Earnings are on deck. So again, amongst everything else that's going on, this is shout out to Earnings Whispers, who puts out some great content around earnings. Stole this graphic from them. You can find them on X at Earnings Whispers, but there's a lot of things, a lot of catalysts now coming company specific. We're going to see just how strong these companies are faring. Notably, you've got Netflix on Tuesday, you've got Tesla on Wednesday, you've got Intel on Thursday. So, and plenty of other names in between here that will, participate or be in the pipeline of the AI kind of build out and the CapEx super cycle there. So it'll be an interesting earnings, season to say the least. And there's some econ data out next week, but of course government closed, so we don't get full insights here on some of the data that we would expect. So that's the big roundup. I want to end this video with looking at some of the trading systems that we run here. And so we have our long-term model, because there's a lot going on. And so to see how a portfolio is positioned, this is our long-term kind of all-weather portfolio. 87% exposed, so it's still very long in this market. Again, it's kind of diverse across these 8 different ETFs here. So you can see we still have plenty of exposure in the market right now. It's not all just equity risk though. It's a handful of different things. And it's, continued to fare pretty well. 5.5% was the performance returns in September. And since trading live, 51 versus the S&P at 41. If we go to our short-term trading system here, this is how we're kind of navigating the real near term, very cash heavy. So right now our Lamerick tactical system is actually only 25% long. We did take an exit here intraday. So our long exposure going into the weekend is 25% long, 75% cash. So very kind of risk off, not shorting, not heavy on the long side or short side, just kind of waiting for some more clarity here in this range. And I got to say, that's personally something I'd find very comfortable with. And if we look at our momentum model, this is where I want to spend just a little bit of time, because I do think if you do get a downdraft here in the market, you want to have a shopping list ready. And our quant rockets, momentum, kind of looking for these explosive stocks that have some real beta behind it. I think these are some of the places you want to spend some time looking. Something like a Western Digital, which we've been in for quite some time now, 54 days, and it's really not giving too much back. But if you can get some pullbacks in some of these thematic names that are benefiting specifically from, the AI CapEx cycle, that I think is where you could look for your 10-15% correction. Something like an MU, again, we've had it on for a little while. If it can reset back into the 180s, that might be interesting. Tesla, I've got a position here. We've been in it since the beginning of August. This consolidation, it's holding up well. I mean, if it can stay in here and you can get some type of second entry breakout, I think that's interesting. And then, of course, you just have a few more names here as well. So this is kind of the inside baseball dashboard. These are just the names I favorited. There's about 50 names on the list right now, but you can see how our model back tests against them, and you can see entry points, exit points, and kind of momentum signal strength. But all of this is to say, I mean, having rules and having processes right now, while volatility picks up and while there are so many headlines coming across the screen, is, of most importance, right? So at this point, I would say watch the 590 in the Qs, watch last week's lows, Friday's lows. That's going to be your kind of oh shit level here for risk, I would say, in markets. And if we're holding above it and we're digesting and earnings come in good and China deal happens and there's no contagion in the, spread across in regional banks and the SOFR starts to come down, then hey, life can be good and we can get that big Santa Claus rally, and we just got a lot of people to worry, VIX to spike, and the bull market continues. But it is a time to just be acutely aware of what could go wrong, right? And that's why we do these videos. We present the data and we try and help you navigate 1 week at a time. So that is all I have for this week. Do some get some research in on some of these things I talked about, map your levels, find the stocks that you want to own at the price you want to own them, and check out the links we have in the video, in the description of this video. Thanks as always for tuning in. Have yourself a great weekend. We'll see you back here next Friday. Take care.